Hello, good afternoon everyone. Welcome all of you in today's first session online study circle meeting, that is TDS on remuneration to partners under section 194T. I request President Advocate Deshpande sir, please come on the dais. I also request Chairman Navneet Lal Bora sir, please come on the dais. Treasurer Kailas Kashit sir, please come on the dais. And committee member Subhash Nautke sir, please come on the dais. I welcome on Zoom meeting today's faculty, CA Nitin Bhutta. Please give a huge round of applause for them. Welcome once again. I, Ms. Ashwini Bidkar, convener of the study circle meeting, once again welcome all of you on Zoom meeting for today's first session, TDS on remuneration to partners under section 194T. To proceed further, I request Chairman of the study circle meeting, Mr. Navneet Lal Bora sir, to for his opening remarks. Sir, please.
Hello. Good afternoon, everyone, and welcome to today's study circle meeting. I'm excited to introduce our two distinguished speakers who are renowned experts in their respective fields. Both speakers have invested significant time and effort into mastering their subject, and we are fortunate to have them share their insight with us today. Let's make the most of this opportunity to learn from their expertise and engage in meaningful discussion. Thank you very much. Not taking more time.
Thank you, sir, for your views. Now I request President Advocate Prasad Deshpande sir to express his views.
Namaskar. Respected dignitaries on the dais, Galaxy of Past President, Senior Member of Association, all the participants present in the hall and on Zoom platform, my brothers and sisters. Good afternoon. I, on behalf of Maharashtra Tax Practitioner Association, welcome you all in the eighth study circle meeting on the very important topics TDS of remuneration to partners under section 194T and latest amendments of hotel industry and restaurants. I am thankful to today's speaker, CA Nitin Bhutta sir from Mumbai and Advocate Janak Dalal madam from Surat for accepting our invitation. I am delighted to see all of you here today as we embark on this journey of learning and growth together. We at our association regularly organize various educational programs for updation of our members. We are arranging regularly seminars, webinars, study circle meeting, and a workshop on the subject of income tax and GST, as well as allied laws. We request all the members attend all such events regularly and also give your suggestions for selected topics. I encourage each of you to actively participate, ask questions, and share your experiences. Let's make this study circle a platform for collaborative learning and professional developments. Thank you once again for joining us today. Let's make this session insightful and productive. Thank you very much.
Thank you, sir, for sharing your views and giving details of this session. Now I request committee member Subhash Nautke sir to introduce today's faculty, CA Nitin Bhutta.
Good afternoon, President Advocate Prasad Deshpande sir,
Chairman of Study Circle Committee, Shri Navneet Lal Kaur sir, Convener, Mrs. Ashwini Bidkar Madam, and Treasurer Kailas Kashit sir. Myself, Subhash Godke, Managing Committee member, welcomes all of you in the 8th Study Circle Committee. I am very much honored and proud feel to introduce CA Nitin Bhutta sir. Sir is distinguished chartered accountant with an illustrious career spanning nearly 3 decades, a rank holder at the intermediate level of ICAI examination. Sir has established himself as a trusted expert in the field of taxation, accounting, and management advisory services. As the proprietor of Nitin Bhutta and Company Chartered Accountants, he has provided invaluable guidance to number of corporate and non-corporate clients. Sir's experts extend to direct and indirect taxation, litigation, and management advisory services. He is a regular contributor to prominent publications and has represented the ICAI in various capacities. With his vast industry exposure and commitment to excellence, Sir continues to be a respected name in the field of chartered accountancy. With this short introduction, we welcome Sir with a round of applause.
Thank you, sir. Thank you, sir, for such a nice introduction. Now, I request President Advocate Prasad Deshpande, sir, to felicitate today's faculty and Treasurer Kailas Kashit, sir. Please accept the same on behalf of Bhutta. Thank you, sir. Without wasting of any time, I request today's faculty, CA Nitin Bhutta, sir, to share their valuable knowledge and enlightening us. Hand over to Nitin, sir. Sir, please.
Good afternoon, everyone. Please share the presentation rights to me, please.
Hello. Hello.
Is this visible? Whether the screen is visible?
Yes, sir. Yes, sir.
Okay. Thank you, Mr. Bora, for inviting me. Thank you, Mr. Deshpande, for helping me out to share what is about to be discussed with the participants. I thank my co-speaker, Ms. Jhalak Dalal, to accommodate my time. She was to speak first and I was supposed to speak second, but she accommodated me. Thank you, Mr. Subhash, for the kind word of introduction. With this, now since the time is 3:15, sir, just I need one clarification. Should I complete exactly at 4 o'clock or should I complete at 4:05? Because I don't want to take up the time of the co-speaker as a policy. Hello?
Hello.
Yeah.
Hello.
Hello.
Yeah.
Yeah. So I will finish my session by 4:05. Jhalak madam, is that okay with you?
Yes, sir. No issue.
Thank you. So today's topic, what we are going to discuss is related to the most discussed topic in the social media on section 194T, which is precisely discussed about the TDS to be deducted on the remuneration payable to the partners. Before I start session, let me tell you, whatever I'm going to express, they are my personal views and it is not binding on the ICI or a study circle or MTPA. I would urge everybody to go through the law provisions and then decide whatever has been discussed during the session is accurate or not. And if I discuss any examples and which are similar to your clients, please note that I don't want to discuss anything in private, but that is probably just coincidental to discuss for the discussion's sake. Today's coverage is going to be TDS on remuneration to the partners, followed by allied laws vis-a-vis the income tax, disallowances on the remuneration payable to the partners under section 40B. What are the impacts on the TDS disallowances if we don't deduct, related party transactions, FAQs, and the comparison of the existing law vis-a-vis the new income tax bill 2025. So typically when we look at the provisions of section 194T, which talks about the TDS to be deducted on any kind of a remuneration that is to be paid to the partners of a firm or a LLP. Every one of us know that there is no threshold limit on which the exemption is available to the firm. So from every 1 rupee, the tax is required to be paid. And we know firm is subject to tax at 30% plus surcharge plus cess. Here the question comes ki why this provision was introduced by the government. Government was of the view that the majority of the firms are paying the remuneration to the partners, but it is not contributing the tax collections to them. And with that intention, or there was another reason also, they felt that many partners are not reporting such a information in their income tax returns. To plug such a revenue leakages, they introduced this particular section whereby the rate of TDS that is provided is around 10%. But when we look at practically, almost with the advent of the technology, any kind of a non-reporting is virtually minimal nowadays. 10 years back, I can say that was a reality, but today that is not a reality. Why there was a need of introducing this provision? It is a purely way every time we see the new sections are introduced on account of the TDS or TCS collections, which all of us are privy to. I'm not going to discuss any other section, but I will stick to this section only. But here, before I go to this particular section, I would like to share one view which I hold, which maybe many of us would be thinking, as many are uncomfortable with the idea of doing the TDS deductions under section 194T. Will that prompt the reshuffling of the business reorganizations, whereby whether they will opt for converting from partnership firm to a proprietary? Especially when I consider section 87A provision from the next year, we have up to 12 lakh rupees of income. No tax would be payable because of the rebate if you opt for a new tax regime. So for example, if a partnership firm is doing a trading activity, it discloses 8%. But if I convert that entity into the 2 units of proprietary concern, then I can take the tax benefit in 2 names and I relieve myself of the burden of 194 TDS. It's just a food for thought. One can look at that particular angle because there are plethora of compliances to be done in the partnership firm. We will, as we go to the couple of next slides, we will understand. Let us be very clear about the applicability of section 194T. It applies to a salary paid to the partners, or a commission paid to the partners, or a bonus or interest paid to the partners. And this provision of the TDS is applicable from the financial year 25-26. For financial year 24-25, this provision is not applicable at all. But revised limits of the remuneration which are provided under section 40B5 and 5A, they are applicable for the financial year 24-25. But that is also dependent if firm has modified their partnership deed by way of making a changes to the reference relating to the remuneration payable to the partners. But if I amend my partnership deed today, can I get the benefit of the increased limits? That is a food for thought. Right now I'm parking, but I will touch upon in the next couple of slides. Let's touch upon the few basics that are applicable. Once the TDS provision is applicable, one needs to file the TDS return as applicable, either as if the partners are resident, then 26Q, and if the partners are non-resident, 26Q will be applicable. TDS that is to be paid, which everybody is aware, 7th of the succeeding month for any month that we deduct. For March, it is up to 30th April. And once you file the TDS certificates, you got to issue the TDS certificates. And if you don't file TDS returns or issue TDS certificates, consequences would follow. One more thing, once any TDS is deducted, it is required to be reported in clause 34 of the form 3CD if the tax audit is applicable. Otherwise, there is no reporting requirement. But that is only for the assessment year 26-27. For assessment year 25-26, 194T is not applicable. So any remuneration that is paid to the partners from April 2025 onwards, that will be subject to TDS. And when I'm deciding the TDS applicability, I need to aggregate the remuneration, that is salary, commission, or a bonus, and the interest. That is to be aggregated, and the limit exemption which is provided up to 20,000 rupees. That is not to be applied individually, but it has to be applied cumulatively. And TDS will be deducted based on the payment or a credit entry in the capital account of the partner. Here one question that comes to our mind, if the remuneration is provided in the partnership deed, but the credit is not given to the partner's capital account, or the payment is not made to the partner, it will be made in future. But since it is provided in the partnership deed, and if a firm is following mercantile system of accounting, whether the TDS should be required to be deducted basis that, because there is no accounting entry passed in the books of accounts. Here another one more question that one needs to keep in mind. For withholding tax provisions under section 194T, there is no option provided under section 197 or 197A to seek lower tax deduction at source. So that option is ruled out for 194T. That is not there at all. Before we go to any substantial provisions of the law, let me tell you, allied laws will play a very, very significant role, and we need to compare firm and the LLP. They are on the similar front. LLP is under the respective regulations, and that is to deal with the MCA. Individually, people are called partner, and jointly they are called partners. In an LLP, we designate the partners as designated partners. But when I look at specifically, if I look at section 223 of the Income Tax Act, the firm is defined by comparing with the definition given under the Indian Partnership Act 1932 or reference of the limited liability partnership. And so whenever we are not clear about any provisions under the Income Tax Act, we need to refer to the parent provision, which is the Indian Partnership Act or LLP as applicable. Section 4 defines partnership as the relation between the persons who have agreed to share the profits of a business. Here they have said it is to share the profits. Does that mean if the losses are not to be considered? But typically we know the judicial precedents, profits include the losses. It is a negative profit. And it is the business activity that is carried by all or any of them acting for all. So this is the most fundamental aspect that is to be kept in mind when we are evaluating the firm. We know who are called partners. I'm not getting into this, but the activity in whose name the activity is carried out, that is known as a firm name. If I do a comparison with the LLP Act, Section 2Q talks about the partner in relation to limited liability partnership, means a person who becomes a partner in the limited liability partnership in accordance with the agreement that is executed. Under the Partnership Act also, agreement is a must. And under the income tax also, the execution of the agreement is a must as per Section 184. Section 2J defines the designated partner. It's only a definition. If the so and so person is called designated partner for the compliance purposes. Any change in the partners of a limited liability partnership shall not affect the existence, rights or liabilities of the LLP. So it is a perpetual succession. Whereas when I refer to the Indian Partnership Act, if the deed is silent, then on the demise of the partner, that partnership will come to an end, or as it will go on by the terms that are provided in the partnership deed. And when we read Section 223 very minutely, it's also giving us support to refer to the Partnership Act or LLP to decide. So whenever we have a ambiguity in terms of the what is applicable and what is not applicable, and that source is not available from the direct tax provisions, then we will refer to the parent law. Here the relationship is governed by the contract. But when I look at the Indian Contract Act, it provides for the oral or even an oral agreement is considered to be the valid. But under the partnership, it has to be a written agreement. Same logic applies with the LLP also. Same logic applies with the income tax. But here one thing, very category we should remember. Ki members of HUF carrying on a family business as such, or a Burmese Buddhist husband and wife carrying on business are not partners in business. And this is as per the Partnership Act. So when we are evaluating the situations under the Income Tax Act, this aspect has to be kept in mind. Body corporate has been defined under Section 2D, which is a limited liability partnership registered under this Act. So LLP is a body incorporate. It will have a perpetual succession. Coming to the provisions of Section 184(1), which governs the assessment of a firm. Partnership is represented and evidenced by the deed or an instrument which is executed between the partners. Individual shares of partners are specified in the deed. So this is one of the essential requirements. If the shares of the partners are not specified, typically all of us know it as a profit sharing ratio. It can be in the profit or it can be in the losses, or that can be vary. Depends. But here one question it comes, key under the Indian Partnership Act, if I have a property and I decide to do a revenue sharing, will it be termed as a partnership? And if I draw any money on account of the revenue sharing, which will be also again the subject to section 194T, the answer is no, it will not be. Receipt of a person of a share of profit of a business of a payment or contingent upon earning of the profits or varying with the business earned by the business does not itself make him a partner with the person carrying on the business. And that is what is provided under the Partnership Act. And this is what is defined under the LLP, who can be the partner. So even that aspect has to be kept in, and similar definition is also provided under the Partnership Act. Section 184(2), certified copy of the instrument of a partnership referred to in subsection shall be accompanied by the return of income for the first time. As we see the subsequently, section provides that even whenever there is any change in the terms of the partnership deed, especially when we are discussing with reference to the remuneration payable to the partners, in view of the increase in the limits, do we modify the deed? Are we required to file such a deed with the assessing officer or jurisdictional assessing officer? We will touch upon. This is very, very important, especially when we are looking at the change. Had taken place in the previous year. When I say previous year, it refers to 24-25. The firm shall furnish a certified copy of the revised instrument of partnership along with the return of income for the assessment year relevant to the previous year. So are we supposed to file revised deed with the assessing officer? But nowadays everything is done electronically. So do we still file, or what do we do? The support is provided by the Rule 12, which says the return of income shall not be accompanied by any document, form, report of the audit required to be attached with the return of income under any of the provisions. In this case, whether the act provision will survive or rule provision will survive. In my opinion, we did not file any documents with the jurisdictional assessing authorities, but at the same time, any changes that we are doing, please do well within the time limits and keep a certified copy of such a document in your hand. As and when it is asked, it can be provided to the tax authorities. And one very, very important thing, section 184(5), notwithstanding anything contained in any other provisions of this act, in respect of any assessment year, there is on the part of the firm any failure as mentioned in section 144. So 144, everybody is aware, is a base judgment assessment. The firm shall so be assessed that no deduction by way of any interest, salary, bonus, commission or remuneration by whatever name called. So whatever the nomenclature that you are using to pay to the partners shall not be allowed as a deduction. I think there is a typo error here. And here one question that comes, if their remuneration is not deductible, do I still deduct the TDS under section 194T applicable from assessment year 26-27? Before we subject, but due to changes is required, we need to modify the deed, file with JAO or MCA. MCA though we will file because anything that changes happens in the LLP agreement are required to be filed electronically. With the JAO, we are not supposed to, but we need to maintain the copy. But most important, most of the firms will have a TAN number, and if they don't have a TAN number, they need to apply for a TAN. If the TDS is applicable, we need to deposit on a monthly basis, file the returns on a quarterly basis, and issue the TDS certificate as applicable. Here the question comes ki, if I execute the partnership deed today, with the changes of the revised limit of the remuneration, can I claim the limit retrospective or it has to be a prospective only? The answer to this question is, it will be prospective only. It cannot be retrospective, especially when we look at the provisions of section 40B, 3 and 4, which provides that any prior period remuneration paid that will not be allowed under section 40B. This we already touched upon. It should be evidenced by the instrument, individual share of partners, and if the shares are not specified, again, that will not be considered as a valid instrument, and that remuneration paid or not payable will not be eligible for. 144, most of us are aware, but if there is a failure on account of section 144, then no remuneration can be claimed as a deductible under section 40B 5 and 40B 5A. These are the various instances that are given in section 144. I think I'm sure everybody is aware about this particular thing. I'm not touching much on this particular section because most of the tax practitioners and the hardcore chartered accountants will be aware. This is very, very important, especially which we have seen. Whenever there is a changes that happen in the partnership deed or LLP agreements, especially when the tax audit is applicable or regular returns are filed under section 139(1), impact of changes on carry forward of losses are not properly reported by the many of the taxpayers or the advisors. And if the tax audit is applicable, such effect is required to be correctly reported, considering the provisions of section 78. Oral arrangements will not be accepted. Whatever is written in the black and white, that will be there. But here the question it comes ki, when we say the remuneration is that is paid to the working partner, that is deductible. But if the remuneration is paid to the non-working partner, that is not allowable under section 40B. So in that case, whether the interest is paid to the working partner and non-working partner, so whether the interest to non-working partners is disallowable under section 40B 5A, answer is it is allowable subject to the limits that are provided under section 12 of 12%. If it is 14%, then 2% you will disallow, but you will consider only the simple interest, not the cumulative interest. That aspect has to be kept in mind. Here I'm going to spend some reasonable time to discuss only working partners. And working partners are assumed to be active in carrying out the business activity. So if the partner is not the active partner, is not taking participation in the business activity, then they will be termed as a non-working partner and that they will be disallowed. But when I read section 40B very minutely, it says कि remuneration and interest payment should be authorized by the deed. So if I provide the authorization in partnership deed, but I don't quantify. When I say quantify, I will not specify the amount to be paid, but I said कि in future, when I draw up my profit and loss account, and in proportion to the profit, I will draw the remuneration. Will that be allowed? If it is not authorized, there is no question of allowability. That is very, very clear. But if it is authorized, specified, the remuneration is to be provided, paid based on the profits. It does not say 20,000 a month or 30,000 a month or 50,000 a month or 1 lakh a month, whatever the numbers are. So what happens? Circular 739 says कि we have to consider it the other way around. It should be quantified also. So that circular, when it says it is to be quantified, but the acts say only authorized by deed, then what do we do? Will it be allowed? I'm parking this question right now for the benefit of all participants. Let's go to the second right-hand slide. Prior period remuneration and or not authorized in deed or pertains to the date of such earlier partnership deed. So if you do any changes in the partnership deed today, that will be effective from today, but not pertaining to the earlier period. So that aspect you should keep in mind. Interest, I think most of the people are aware. Anything you pay beyond 12% will be disallowed, and that is only simple interest, not the cumulative interest. Book profit, everybody knows. Limits of remuneration are on the first 6 lakh rupees and balance 64. But typically, do we really make a change because of these changes in the remuneration limits provided for? Practically, we have done the calculations and effect is very minimal, say 9,000-10,000 rupees. So for doing all this, gaining a benefit of only just 9,000 to 10,000 rupees, do we really execute such changes in the partnership deed? My personal view is no. Whatever changes that you want to do it from 1st April 2025. But everybody can take their own views. If a partner is a resident partner, and if the TDS is not deducted under section 194T, then that will be subject to disallowance at the rate of 30%. But if the partner is non-resident, in that case, disallowance will be 100%. So that aspect is to be taken, and if the tax audit is applicable, you will report appropriately in the tax audit report. For domestic, you will report only 30% of the amount, whereas if it is an international transaction, you will report only 100% of the. So for example, if a remuneration of 1 lakh rupees is disallowable because of the non-deduction of the TDS at source under section 194T, in respect of the resident partner, you will report only 30,000 rupees in the respective sections of the tax audits. And if the partner is non-resident, then you will report 1 lakh rupees. So that is a difference which we need to keep in mind, because lots of mismatch notices do flow in because of the way wrong reporting. This is just for the notifying for the benefit of the people. This has been touched upon here. Very, very important thing. Related party, everybody is aware. Typically, what we have seen is that remuneration payable to the partners is finalized at a much later time than at a regular thing. But ideally, we recommend that whenever you are finalizing your balance sheet, finalize it in advance. So it really helps all the parties. As far as the disallowance is concerned, in the ITR, we are not supposed to touch upon anything. We just need to report the value. That's it. We are not supposed to quantify anything. That will be done by the assessing officer. But here the question comes, it is a partner's remuneration. If I pay as a percentage of the net profits, will it be allowed? It will be allowed only if it is provided in the partnership deed. It is possible. It is possible. But then again, you have to do the compliances properly. But if the partner is non-resident, then transfer pricing compliances are to be done by everybody, where a lot of mistakes are happening. And government is monitoring this aspect very, very significantly. And remuneration to the partners is a related party transaction under the Income Tax Act. Here the first question that comes, if a payments are made to the partners or a designated partners in their name or in the associated concerns on which the TDS has been deducted under the various sections, I am assuming all of the requisite requirements are satisfied of the respective sections. So will I deduct the TDS under section 194T on such payouts? In my humble view, once the TDS is deducted under any other section, then on the same payments, 194T does not apply. It does not apply categorically. If a partner or a designated partner is having a credit balances in the capital account and withdrawals are debited to the capital account, then TDS will be required to be deducted under section 194T. If it is a credit balance and if the partnership deed does not provide for any kind of remuneration, then such withdrawal shall not be subject to tax deduction at source under section 194T. If the partnership deed is providing for the remuneration payable, then 194T will come into the picture and it will be aggregate payment that is required to be considered. If remuneration is credited on 31st March, then TDS shall be deducted on 31st March. It is on next year, 31st March 2026, not 31st March 2025. But if a deed is providing for a monthly payment of remuneration, but in books of accounts it is credited on 31st March, then in my humble view, TDS is required to be deposited based on the monthly payments. So it is payment or date of credit in the books of accounts, whichever is earlier, that all of us are aware about the TDS provisions under chapter 17B. Whether section 194T will apply to a registered firm only, or it will equally apply to the unregistered firms also. In my humble view, tax TDS is linked to the firm. The definition provided under the Income Tax Act as per section 223 does not differentiate between the registered firm or an unregistered firm. So 194T will apply to both equally. If there is a change in remuneration payable, but no change in PSR, that is profit sharing ratio, whether the revised instrument need to be kept on record for assessment purpose, answer is yes. If there is a change in profit sharing ratio, it is definitely, but even if there is a change in the remuneration or the interest payable to the partners, then also such deed should be kept on record. Certified true copy. One will be original, certified true copy can be given to the assessing officer. if a remuneration is paid to the karta of a HUF, whether the provisions of section 194T apply or TDS will be deductible under any other section. Here the answer is the karta is working in his individual capacity, and that remuneration he will be drawing in his personal capacities, whereby it will be TDS on salary under section 192B, or if he is rendering the professional services, then it will be 194J, and consequently section 194T shall not apply. If a firm is following the presumptive scheme of taxation, which many of us are aware, TDS is deductible under section 194T. This can be discussed for hours together, but the answer is if the partnership deed provides for the remuneration, then TDS will be deductible, even though you are offering income to tax as per the presumptive schemes of taxation. What do you mean by working partner? Typically, he is involved in the business policies, he is involved in the implementation of such business policies, effecting business transactions, in conducting day-to-day administration, doing routine jobs and so on. He can be full-time partner or he can be part-time partner also. There is no bar. He can still be a working partner. Let us look at who can be called a non-working partner. A person who is not having a business knowledge. He is just because of partner because he has contributed the money as a capital or he has funded the business. He is not involved into the business transactions or conducting day-to-day affairs or the administration. He can be a non-working partner also, but he is attending temporarily in the absence of a regular partner. Then also he will be termed as a non-working partner. And once he is a non-working partner, disallowances of any remuneration paid shall apply. If a firm is taken over by a company, and if the remuneration is paid to the business advisor of the company, who happens to be one of the partners of the firm, whether 40B will apply and 194.2 will apply, answer is it will apply. Because he is getting the remuneration as a partner. Consequent to that, these provisions shall apply. If deed provides that a remuneration payable to partners as per the method of quantification given by section 40B, whether TDS deductible under section 194T based on the accrual or a payment basis, there is a judgment of the Calcutta Tribunal in case of the Priya Gopal Bishnoi grandson held that such remuneration was deductible. Similarly, Delhi High Court also has held it is deductible. So when we do a partnership deed, where we had referred about that particular circular when we were discussing, partnership deed authorized but not quantified. So as far as this is concerned, I am anticipating a clarification to flow in from the government in future how the TDS is required to be deducted. Because typically each partnership firm will be filing the returns by 31st July or 30th September or 31st October, depending on the applicability of the audit or not. But in that case, if the TDS is deductible under section 194T, it is for the financial year 25-26. And if I'm filing the returns by 31st July 2026, my time limit to file the returns is already expired. Whether that will happen, I am expecting definitely some clarification to flow in from the government on this ground. This is what we discussed, and that is relevant to this. So whether assessing officer can disallow salary to the partners? There is a judgment of Suman Construction in Pune. AO cannot disallow salary to partners because of the reason salary not quantified by the D. And Pune Tribunal has clearly said that CBDT has no jurisdiction to substitute the term authorized occurring in 40B with the quantify in its circular number 739. And this judgment we should use very, very wisely to defend the matter. TDS on 194T will definitely come, but as I told earlier, some clarifications should flow in. If clubbing provisions are applicable amongst the partners, then in whose hand the TDS will be required to be deducted? In whose account you are going to make a credit? In that person's name, you are supposed to deduct the TDS. Clubbing, as per section 64, will take its own benefit. Who will claim the TDS? That option is available. It can be relationship between a husband and wife, father and minor son and daughter, anything. We are very much aware how do we claim the TDS credit in case of the clubbings. If the TDS is deducted under section 190/40 on remuneration as per deed, but at the time of finalization of the firms and LLP's ITR, interest in such remuneration is disallowable in the hands of firm, then how to claim a credit for such TDS in the individual returns, whether any clarification is available? I am anticipating clarification to come, but there are some people who have a view that to the extent of the disallowed remuneration or the interest, it will be treated as exempt income, and they have been treating that. But I will prefer, especially with the introduction of section 194T, some clarification will come, or they may provide a treatment which is aligned to section 194N, whereby the carry forward of the TDS will not be permitted, so that it can be offsetted or claimed a refund as the case may be. Any TDS deducted under section 194T will be treated as a prepaid tax, and you can plan your advance tax liability accordingly. If the payments are made to the retired partners, whether TDS under section 194(2) would be deducted or applicable. My humble view, he is not a partner, but he is a retired partner. So 194T shall not apply. Similarly, if the payment is made to the legal heirs of the partner, whether 194T would be deducted, answer is no. Again, he is not a partner, as provided under section 223, as per the Partnership Act 1932, as well as LLP Act. If a pension is paid to the retired partners or a legal heirs, similar analogy can be applied. If the say you want to take the advantage of the revised remuneration limit and you revise the deed, firm cannot claim the higher limits, but it can be structured in such a way you can provide, say from today till 31st March, partner remuneration is so and so. From April 2025, the remuneration limit is different. That can be documented. That is possible. But if you say retrospective effect, then that will not be possible. If the remuneration is paid to the partners as per the limits provided under section 40B, whether disallowance under section 48(2)B can be attracted on the grounds of excessiveness by the assessing officer or a faceless assessment, answer is no. If the remuneration is provided as per section 40B, then there is no question of disallowance under 48(2)B. If a lower rate of interest is provided as per deed, can you claim 12%? Answer is no, you cannot claim. And that is provided by the clarification provided by the circular of 12th of 2019, which says whatever is provided in the deed, that will be only deductible. If an interest is paid to partner in a representative capacity, then whether the limit of 12% apply? And if it applies, whether the TDS under section 194T. Take an example, individual and the HUF giving loans to a firm, and HUF is a partner in a firm. So if any interest is paid to the individual, 40B limits will not apply, 194T will not apply, but 194A will apply. And any payments that are made to the HUF being a partner, 40B limits shall apply and 194T will apply. If an interest is paid to a person who becomes partner subsequently, whether the 40B disallowance will apply? Answer is no. That is provided in the Rajkumar Singh case of Allahabad. If a money is borrowed for a business requirements of the firm, whether the disallowance under section 40B is attracted. Here the Q, for example, it is borrowed in the individual capacity. If so, disallowance will get attracted. That is provided under section Agra Tannery Judgment of Punjab and Haryana. But if the partners are only lending the signatures for the availing the funds by the firm, in that case, disallowance shall not apply under section 40B. That is the judgment of Damodar Das, Jaichand Agarwal. Very good judgment to read, and it can help to plan the taxes properly if you can study it. If interest is paid to the partition member of HUF, whether disallowance under section 40B would trigger. Again, it is the partition members of HUF, they are not the partners. So 40B as well as 194D does not apply. If interest is settled by the partners amongst themselves, if provided in the deed, that is permissible. TDS under section 194T will apply based on the limits as applicable. And this is the judgment to support that internal adjustments of the interest is permissible. Interest is paid on the enhanced capital due to revaluation of the assets, whether disallowance will trigger. Section 40B says that it is only a simple interest. So if I enhance my capital, whether disallowance will trigger? The answer is it will not trigger. 40B will not apply, but 194T will definitely be applicable. When I compare the provisions of section old Income Tax Act with the new Income Tax Bill, only the sections are renumbered, some words are changed, otherwise it is the same thing, absolutely no change, except one provision. Provisions applicable to the past assessments of the firm which were provided as per section 189A, that is missing under the new Income Tax Bill. And 194T is covered by section 393 and it is covered in the table. I always say surround yourself with the people who talk about the vision and ideas, not people. Thank you for the patient hearing, and I think I finished my presentation in the time that is allocated to me. Thank you. I hand over the proceedings back. Hello. Hello.
Hello. Thank you, sir, for such a knowledgeable lecture. I request Secretary National Narode, sir, for open comments.
Thank you, ma'am. Very good afternoon to all of you. The President of our association, Mr. Deshpande, sir. Study Circle Committee Chairman, Maneka Bora, sir. Treasurer Kailash Kashit, sir. Committee member, Ashwini Bhutta, Ashwini Bhutta, madam. And committee member, Subhash Kothi, sir. And of course, the today's faculty, CA Nitin Bhutta, sir. Sir, on behalf of our Maharashtra Tax Practitioner Association, I extend our heartfelt gratitude for delivering such a nice, very insightful session, very informative lecture. Your session on TDS and remuneration to a partner, section 1940, conducted through this online Zoom platform was truly valuable and enriching. We deeply appreciate your efforts, knowledge, and the clarity of the subject when explaining this subject. Your contribution is highly benefited to all the participants. Thank you once again for your invaluable contribution and the support. Thank you, sir. Thank you very much.
Sure. Madam, I have to leave.
Yes, sir, surely.
Jalak madam, I'm sorry I cannot continue.
Can you share your
I have
views?
another commitment for the day.
Okay, no problems.
Hello. Sir, can you hear me?